All right, we are live. What's going on, broker family? We have mortgage legend himself, KP from PRMG. How you doing today, buddy?
PRMG, Paramount Residential Mortgage Group.
What did I say? Today is a day, my friend. I apologize. PRMG, unbelievable wholesale lender, incredible partner of the BAC, supported from day one, and one of our biggest cheerleaders. So thanks for being on here, man.
Of course, man. You asked me to go live. I'm game. Now we just got to work on our live discussion with Phil at the end of March.
I think that's going to be a good one. So if you guys haven't seen yet, we've got well, actually you haven't seen yet because we're finalizing the dates. We're going to do a Facebook Live with Phil Schumacher from Loan Store and KP, hosted by Lindsay McKay. On our last board meeting, KP and Phil had a very spirited and respectful, but spirited back and forth about Fannie and Freddie coming out of conservatorship. And these are two of the people that I respect the most in general, but especially on this particular topic. And they had very different opinions. And I love it when two informed, intelligent people have different opinions and can talk about it respectfully. And we're going to open that conversation up to everybody at the end of the March dates being finalized, but keep a heads up on that.
Phil's a good dude. We go way back to the original private giant wholesale lender, First Magnus. He built their tech, him and Dominic Marchetti, they built the tech, the LOS. And, I was an AE and then a sales manager and then a regional manager moving around from Austin to Tampa to Florida. So I've had wholesale in my blood since day one, March 2001.
I love it, man. I love it. I wasn't that far behind. That was 2005. This is year 20 for me, man. So we're rocking and rolling.
No grays yet. No grays yet. Yeah. Who's your hair dye?
You can
stylist.
Look closely. When I see you in DC, look closely. they've exploded over the last couple of years. Every day. That's a conversation for another day. Today, we're going to talk about a couple things. I'm sure we'll kick it around and probably talk about some things I had no idea that we were going to discuss as well. But as always, I'm paying attention to the chat. If you have any questions, fire them away in there, and we'll answer them as we go, or round them all at the end. But KP, what you know as well as anything out there is what's going on in the market, what's going on with interest rates, what are you seeing, what do you think's happening? Kind of just talk at us, and I will pretend. I mean, I will play the role of the uninformed broker and probably have a bunch of questions for you. But what are you seeing going on right now?
Well, I think just in the last 2 weeks, we've seen a little reprieve in rates that everyone before the year started said was going to happen, that we would have trending down rates. And rates trending down is the catalyst for us. Our business is very rate driven. It opens up a lot of opportunities. And we talk about home affordability and first time home buyers, which a lot of us are in the communities out there hunting for first time home buyers. Rates really drive the action. So, we're in one of those bad news is good news things, So today we get our second reading of the fourth quarter GDP. And, that matters because consumers, spending money makes up about 70% of our economy's growth and our GDP. And it was only 2.3%. And that is not a strong economy. So, this new year starting off with the new administration inherited a weakening economy. And so, but it's not weak. 2% is like even keel. Okay. On the GDP. 4% last year was great, then down to 3%. Showed softening. 3%, 3 to 4 strong. 2.3 is okay. And the bond market has been reacting to a lot of these soft data points, and there's other mechanics going on, right? Like inflation and labor. I mean, we had a huge weekly jobless claims read today at over 240,000 new people. Every Thursday morning, there's a weekly jobless claims number that comes out, and taking like a 4-week average is probably the better way to kind of smooth that number out. And so we're watching. Labor's softening. It's been softening. That again, that's just more. Bad news is good news for rates, right? And so we don't want people losing jobs. We don't want a slower economy. We don't want stagflation or outright deflation, but we have disinflation, and that means slowing inflation. But it's tough out there for people. I mean, I read something that said, the top 10% income earners pretty much hold about $1.3 trillion in savings. And the other 90% are pretty much exhausted their savings. And so, we know credit card debt and even defaults are on the rise. And again, that's bad news, which is good news for rates. So, I put out a really shitty video last night. I normally go Monday, Thursday, and there was just so much economic news that sometimes I'll throw a midweek video on a Wednesday, especially if there's a big number like the PCE coming out Friday, like the Fed's preferred measure of inflation. They call it the personal consumption expenditure. And, nobody does it better than Barry and Dan. And congrats to Dan on his new baby boy.
That was cool.
Yeah, super cool. A cute little kid. I was texting with them. But they really break down the numbers like nobody else. And of course, I'd be remiss to say, if you're not following Logan Mototrami on Instagram, he puts out a lot of good charts and he watches the channels at 10 years, like, as the day starts and ends. And so, I get some of that data from there, but I also have a lot of proprietary analyst subscription services I pay for, literally thousands of dollars. And I try and kind of gather all my thoughts and put it out on LinkedIn a couple times a week. And what's interesting is this Secretary of the Treasury, Scott Bessent, used to be on the bond trading side of things. And now he's on the other side of it where he's, working hand in hand, with the Fed, trying to sell treasuries and fund our government. And what was interesting is last week he said, we're not going to raise the amount of treasuries we're dumping on the market for the next, several quarters. And that was seen as very bond friendly. And he also said they're going to continue to buy and issue, shorter term treasuries. So if they do a 2 year, if they do more 2 and 3 and 5s, when those expire, the thought is that, 2 and 3 years and 5 years down the road, that, the yields will be lower. So when they have to, basically refund it to continue our government spending, that the yield will be lower. And so again, seen as very bond friendly, directly an action from this administration. And so I just want to debunk this theory that bond traders are the smartest people on Wall Street. They're smart at managing risk. They're not smart at predicting the future. And so, we saw the 10-year Treasury since the first Fed rate cut back in September of 50 basis points run all the way up to 480. Now, it didn't run up to 5. It ran up to 480 because the surprise was always going to be to the upside. Tariffs, spending in the government, what the Secretary of Treasury is going to say with that quarterly funding refunding announcement. And so every single time we just get a little bit better favorable thing, we see the bond market, the bond traders, say, okay, we can get comfortable with a 430 Treasury. We don't need to be at 480. We like where we're at. So I think we're heading into the spring purchase season, which has really kicked off in earnest. I mean, for those that are in warmer markets, we're seeing apps up, activity up, and this is our sweet spot. So local originators in the community, that out there hunting for first-time home buyers, it is a nice tailwind to have rates trending lower, and that's huge.
Let me ask. I have like 3 questions based on everything you just said. So do you think that rates have come down enough that buyers who might have been sitting on the sidelines might be jumping back into it? And like my knowledge on this is more on the DC metropolitan market, and like we're not in a soft market. It's not. It hasn't been a buyer's market. Like it's still very much seller's market, but it's also cooled down from where it was. And I'm seeing still plenty of multiple offer scenarios, but less. And like prices are still going up, but not quite spiking as much. Do you think that are you seeing it now? But when buyers that are on the sidelines jump back in, do you think we're going to start seeing like a level of insanity like where we before with contingency getting waived and things like that? Do you think we're anything close to that, or where do you think we are on that spectrum?
Well, your point's well taken. It's very market specific, right? So the DMV area, there's been a little spike in new listings, obviously, because there's 20,000 jobs that just got whacked in DC by Doge, and there's probably more to come. And so in your market, you could see a little reprieve in supply. From what I can tell, it's still very easily absorbed. And so the good thing about rates slowly trending lower is you don't have this mad rush like we did when, the Fed cut rates to zero in COVID, and we had the lowest rates in the history of history. Yeah. And so it's not like, hey, go out and hire, another processor and 5 more loan officers that left the industry in the last couple of years. Like, we're not quite there yet. And to be honest, we may not have that kind of volatility. Yeah, it's fine. I mean, about half the loan officers in the business left, if you count unlicensed loan officers that work at fiduciaries, banks, credit unions, and stuff like that. Those are kind of hard to count because there's no real tracking of the license. But we've taken a 50% retracement from the amount of competition. You compete with your fellow broker, you compete with your bank in your community, you compete at a local level. So it's nice to have rates slowly going down. I think one of the things that's been I've been talking about taxes and insurance for years, but when you see the wildfires and hurricanes and storms and thank God we haven't had an earthquake, as I just got my earthquake insurance policy sent to me. I live in Orange County. We're south of Los Angeles. I've been here 9 years. I was in Fort Lauderdale for 13, Tampa 6 months, Austin 9 years. So I've been in this business in a couple different markets and had a chance to, and obviously in my position as a partner at PRMG and also the chief lending officer over 3 channels, I've had a chance to see, just kind of how all the different markets work, and they ebb and flow. So again, I think it's very market specific. But tax and insurance is a big deal. I'm on the board for the California MBA, the Mortgage Bankers Association. They're fantastic. Them and the TMBA, California, 1A and in Texas 1B, they really do a good job lobbying at the state level. New Jersey has a great MBA, and there obviously there's tons of great state organizations.
We're going to say Maryland if I'm on the call as well, but yeah.
Yeah. No. Colleen Palmer, was with us for many years, and she's on that board and has been, and so I'm able to keep track of what's going on in Maryland too. And so I'm on all their emails. I'm on so many emails and just seeing all the updates. It's crazy. But we just had a 30-minute prep call for the California MBA. I'm on their board of directors. This is going on my 3rd year now, and hopefully a 9-year term, I believe, is the max. And we've been talking about the insurance crisis. It's a hashtag out there. It's a big deal. And these fires in LA, up north of us. I was just there in LA. I was there for the Mavericks Lakers game. It was awesome. I took my 11-year-old daughter who turns 12. Cool. It was super cool. My daughter turns 12, and my buddy Leon and friend from college as well, Brian, they had this company called Tiff's Treats. Great closing gift, sending cookies to bars. Little plug there. Full disclosure, I'm a early investor in there. Took the 4 of us. We went to the game, and we had a little pregame, and we're at this hotel in downtown LA, and we're looking out, and it's just barren over there in the Pacific Palisades. In this one neighborhood, and then Altadena were the 2 major fires. There are a couple other smaller fires, but we have 12,500 homes taken off the market, and at least $30 billion in damage to rebuild those homes, with only about $6.5 billion in the state of California has what's called the FAIR Plan. And it's kind of a state subsidized plan. And they only had $6.5 billion. So they're out. State Farm has said starting May 1st, they'll do 22% increases on all policies. And so I told my wife, I go, hey, send this renewal check in ASAP before they raise our price. And I have an investment property. I'm flipping a house in Palm Desert, and they canceled my insurance because it's an empty house. And so I'm personally feeling it. We feel it. But when insurance carriers, it's not like flood insurance where you have this national fund. Every state regulates their own insurance and catastrophe modeling. And dumbass California a couple of years ago are like, we need to help our borrowers and put a cap on what they can raise the premiums. Well, now the insurance companies don't have any money to offset this fire. It impacts everyone in the country. Yep. So State Farm has this out of whack, and Farmers 1 and 2, big difference between them. they have this out of whack book nationally where they have this huge exposure in California, which now they have actual claims and losses in California. So if you're in Paducah, Kentucky, your insurance is going up because of a fire in Pacific Palisades. And by the way, it's not a bunch of rich people. There's people who live in these houses in these neighborhoods for 50 years.
Yep.
You know, and you've got workers that live there. You've got families and multi-generational wealth that lives there. And this insurance crisis is real. So next Tuesday, Wednesday, I'll be in Sacramento with our board, and anyone else is going up there. And this is absolutely our most important advocacy event of the year. And we're getting all of our talking points, how to talk to all the legislators, and you know, how, you know, they want to hear stories. I had a borrower that couldn't qualify at the end on their DTI because the insurance quote went up. They want to hear those stories. And you and I will be up there together in DC in April, talking about, you know, a whole host of things that impact the wholesale channel. And of course, I'll also be there with the Mortgage Banker Association. So these lobbying efforts matter. You know, you've got these legislators, you know, the senators and Congress people that don't, you know, they don't have the eyes and ears on the ground like we do. So they want to hear how their constituents are being impacted. And the insurance crisis is a big deal. Obviously, taxes is another big deal, but rates is the big driver. So, you know, we can attack it on many fronts and control what we can control.
So, and insurance, like, we're going to prepare people to talk about it. Advocacy in Action. I just dropped a link, April 8th through 10th. Come if you want to be part of these conversations like what I'm about to describe. But the number one thing that we get asked about that wasn't necessarily on our agenda is homeowners insurance. It's not even close. Members of Congress are hearing from their constituents story, just like the one KP said about his insurance policy getting canceled. You know, they're not necessarily looking out for people who are flipping homes, and that's not their number one concern. But you have people who just closed on the home and have their insurance canceled and are looking at forced place coverage, and it's awful. And to what you were talking about, I knew that there was state level legislation like the one you described in California that's screwing things up. Because last year when I was doing research for BAC's response to a CFPB request for information on rising closing costs, and I was looking up on title insurance, only 4% of title insurance premiums are paid out in claims. So of all the money they collect every single year, only 4% are paid out in claims, most of it on new construction. It's, for some context on that number, life insurance is around 50%. Home and auto, I didn't even include because they're currently upside down. They are paying out more in claims than they're collecting in premiums, which tells you that like premiums kind of have to go up. And I was reviewing, you know, an overall policy statement from another organization yesterday to give them feedback on it, and they were talking about homeowners insurance costs coming down, and I'm like, that's going to be a tough sled to navigate. I think a lot of conversations that are happening about it are coming out with more creative ways of restructuring homeowners insurance policies that are still going to be tolerable by the GSEs. So having policies that only cover complete disasters or different things like that, I don't want to get too much. I'm not an insurance agent, so I'm always like careful about getting too far down into the weeds on it. They need to be involved in it as well, but looking at insurance in different ways and still having people have protection that they need and it be affordable, but like something is going to have to change. The current system is breaking, and to your point, California, Florida, and Hawaii is where you're seeing it the worst, but it's trickling everywhere else. Like I'm having issues getting policies, and not far and wide, but like, you know, I've had to make sure, you know, not make sure, but like I'm having borrowers getting denied for policies. We're usually able to find another carrier pretty quickly, but I'm seeing people that they make a second claim and their insurance policy is getting canceled. And I've had 3 borrowers in the last 12 months coming to me with that, and I've never had anyone come to me with that in the previous 12 years of originating. So it is getting felt everywhere, not just in the disaster areas.
And just to put a bow on it, you know, I mean, if, for example, you know, when State Farm pulled out of writing new policies in California, you know, it's almost, you know, about a year and a half ago, farmers couldn't handle the load. You know, imagine if, you know, UWM said, hey, we're at capacity, you know, and then, you know, smaller lenders, you know, like us, we get this spillover. We're happy to have it. But insurance is different because you're getting spillover business that brings on more risk. And so just in Pacific Palisades alone, State Farm, I think, canceled 1,800 non-renewals just in that neighborhood, in that area. And so I don't know if those people were able to gain insurance, if they could, to the FAIR plan. So we have the biggest driver of inflation is government spending. And March 14th, our continuing resolution currently has an expiration. And so this big budget battle is brewing on the Hill right now, how to pass that budget. And one of the things that's being talked about is, from a federal standpoint, is to put some money into reinsurance. And so there's like this second layer behind State Farm and Farmers and all the big insurance carriers, this kind of like backstop, if you will, financial backstop called reinsurance. And the federal level can earmark, some money. So if we stop spending $500 billion in Ukraine and maybe get some money back from them on a mineral rights deal, which supposedly is being signed tomorrow, that's less money going out to a war that, literally had no end in sight. Those two countries hate each other. And maybe there's some more money that can, fund into a reinsurance set of vehicles. And the federal level can come in and maybe backstop the industry and help out. So, taxes, that's a different animal. Home values are going up. We saw Case-Shiller yesterday and FHFA, 4.5, 4.7%, 4.5 on CoreLogic. We all know that we don't have enough houses. And so, from a supply and demand standpoint, there's just not enough homes. And so taxes goes up. And, that's just, we're turning into Europe, right? If you're feeling like, you live in LA and you're middle class, you're being left behind. You can't afford a $1 million to $2 million house. So you got to move to Boise, Idaho, or Dallas, Texas, or wherever. And so, in some of these less expensive places like North Carolina, they get hit with a hurricane and storms and flooding, and now they're living in tents, whereas, our dumbass government is, giving $2 billion to political operatives in Atlanta. Well, what about the people sitting in a tent in North Carolina? So there are some things that are happening in DC in these coming months that could really, really, really help people on the ground. And people are hurting, egg prices. You brought up auto insurance. It was really, really high auto insurance in the January CPI report. That's not sustainable. It's not going to go up every month at the rate that it did. So we'll probably see a little reprieve on that data point on the February CPI. But these things, they ebb, they flow, they go up, they go down, they don't go in straight lines. And the government is the biggest, heavy hand, between our fiscal policy and on DC with the budget and monetary policy with the Fed. Those are the two big hammers that can really set the table for us to be successful or not as originators in the community going forward.
So you brought up the Fed, and this is like a personal interest of mine, and I do think it should be discussed more widely out there. When everyone talks about the Fed and controlling interest rates, they're talking about moving the Fed fund rate, which has an impact on mortgage rates, not a direct one, but it does have an impact as we all know. But to my understanding, what has a far larger impact that the Fed can do is purchase mortgage-backed securities, which they scaled back drastically. And it's my understanding that Chairman Powell, and more notably my high school alumni, Chairman Powell, is not generally a fan of. Is that something that you think that they will reconsider at any point in the future to help interest rates go down, or now that inflation is kicking back into things that they probably would not even remotely consider? Or do you have any thoughts on that?
Yeah. So the Treasury Secretary Scott Bessent addressed this last week as well. And then he went on this big media tour. He was doing a bunch of interviews. So pick your flavor, whether you like Bloomberg or BBC or CNBC or whatever. Trust me, there's an interview with him out there. And so the Fed funds rate is an overnight lending rate to other banks. And so what they, and oddly enough, when they talk about market rates, they really follow the 2-year Treasury. So if the Fed funds rate currently is at 425 to 450, which is 4 3/8, 4.375, you look at the 2-year Treasury, and if the 2-year Treasury yield is down below that, that gives the Fed room to cut another 25 basis points. So we touched 408 yesterday. It's gone up a little bit today, but not a lot. And so if you see that number stay below 4 1/8, okay, even 4%, even better, the 2-year Treasury, that will pull forward a 25 basis point rate cut, which puts them in the 4 to 4 1/4 range, 4 1/8, and they'll be less restrictive. And if we continue to see slowing GDP and weakening labor and whatnot, and softer inflation, more disinflation, less inflation, then you'll see them do that. Now, the 10-year treasury is what really, because most mortgages last, 6, 7, 8, 9, 10 years, the 10-year treasury really is the key there for mortgage interest rates. Now, what's interesting is we're still doing quantitative tightening. So the Fed is still dumping like $400 billion a month of treasuries onto the market for institutional traders to have to buy. And they're also, letting MBS run off or, sell it off. And so not doing a whole lot, right? So what Scott Bessent last week said is, we want to end quantitative tightening this year. So think in middle of the year. And so what that means is there's 400 billion less treasuries to have to buy from the Fed's balance sheet runoff. If they stop their quantitative tightening, then it's a form of easing, even though it's not direct easing. Direct easing would then, the next step would be, hey man, things are really bad. We need to buy mortgage-backed securities. We need to buy treasuries. And so they're stair-stepping into that. And that's obviously the big ace up their sleeve. We go to hell in a handbasket and our economy drops off a cliff and we have labor breaking and, we start to get into stagflation environment and they sense that, they'll inject some liquidity into the system. And they could potentially buy mortgage-backed securities or even buy treasuries. And if they buy 10-year treasuries, that will impact mortgage interest rates. And so those are all things that they have. They're holding in their back pocket. They just letting this thing play out. They work in long, big cycles, and they absolutely can do that. And they've said they want to do that. They said they want to end quantitative tightening. And so that will have a positive impact on mortgage interest rates.
So you're like, they basically, when it comes to this particular topic, have 3 gears: buy, sell, or hold. Right now they're still selling, but like we're hopeful, or they're indicating they might move towards holding, which would not be the same as buying, but like would still have a, would have a very positive impact on interest rates.
Yeah. And then of course the big hammer is the Fed funds rate, right? But overall, they're in charge of liquidity for the world. We buy and sell money, right? We just happen to buy and sell the American dream. It's a mortgage-backed security, a fixed income asset, which is really second in investment grade quality right behind the US Treasury. And so we buy and sell money, and our money is backed by, the home, the land, and the home is collateral and a paying borrower. And so to that point, if they are continuing to shrink the amount of dollars in the world, they've gone from a $9 trillion balance sheet to under $7 trillion. There's going to be a credit crunch. There's not enough dollars to do the things all these economies want to do. The dollar is still king. It's still about 54% of all, the currency being traded in the world. Second place is even close. And so if they continue to shrink liquidity, it will crunch something: commercial real estate, private label securities, mortgage-backed securities, all this flow of money. When they shrink the amount of dollars in the world, it does have a negative impact. That's the point. If they slow economic growth, that's how they crush inflation. And at some point they're going to go, well, labor is getting crushed, economic growth is getting crushed. We're cool with a 2.5, PCE. We're not going to get to 2. Never really at 2. By the way, the 40-year average of core PCE is 2.2. We've never been at 2. We're not at 2. We don't go to 2. So it's kind of a myth when people want to make like this hard line and use that as their logic out there, because we've never really done it. It's a goal. I don't think we'll get there. I think we're in a different world. So they at some point they have to like reflate currency around the world, and that includes potentially, buying treasuries, stop selling treasuries, number one, then maybe buying treasuries, stop running off MBS, and then maybe buying MBS, and of course continue to cut the Fed funds rate. Which, by the way, any one of you can go to the CME tool. It's called the Fed Funds Futures Watch Tool. And you can see now, and I'm not seeing anybody report it, but these smart bond traders, they think the next Fed cut is in June. So it's like 65% or 63% chance that there'll be a Fed cut in June. And a month ago, people were like, the Fed's going to raise the rates. And then the last couple of weeks, they're like, okay, they're not going to cut it all this year. Well, the smart money is saying, they're going to cut in June, as early as June. Now, I don't know when it's going to be. There's a lot of data to come out between now and June. And again, I not to double back on my word here real quick, but they are hedging risk by buying those Fed Fund Futures tools. And if there's a surprise to the downside, especially when you get a 2.3 GDP read, which is not strong, now these people are market watchers are saying, we think there'll be a Fed rate cut in June. So that's kind of where we're at.
Love it. Love it. Awesome. KP, thank you. Before we sign off, two things. One, Advocacy in Action, BAC annual fly-in, April 8th through 10th. I dropped a link in the chat to register. Come. A lot of stuff is happening in DC. You heard about some of it on this conversation. And there's a lot of change happening, and potential for change means that we can have influence on it. And if you want to be part of that change, then show up. Otherwise, you're going to sit around and take what you're given. So we'd love to see you. We're going to push Trigger Lead Bill over the finish line. And secondly, thank you, KP. And thank you, PRMG, for supporting the BAC. If you appreciate the work that we are doing at the BAC, it is because of companies like PRMG that it is possible. So, give them a shot. If you're not working with them, reach out. We can put you in touch with somebody and see if they're a good fit for you. And if they're not, that's okay. But they probably are going to be. You have at least one thing in common, and that's that you care about advocating for the broker channel and the wholesale channel. So, KP, thank you. Anything you want to throw out there before we sign off?
Yeah, I loved your message the other day. It rang so true with me. It's like, hey, we're here to help. We're here to serve. We're here to advocate on behalf of the wholesale channel. I love the fact that you put that out there. It's not about lenders. Of course, there's competition. There's competition everywhere, and there's some great lenders in our wholesale channel. As it relates to PRMG, we just want to be in your top three. Just put us in your top three. You can call us at 2 a.m. if you're drunk. We're here. We're ready. We're like your ex. We're always down. But I'll tell you, all kidding aside, for our Arrive brokers, we're the first big major integration. Our Emerald Jumbo is crushing it in that tech stack. So we've had a couple brokers sign up this week, seeing that. We have a new portal that we're rolling out. We'll be live and off of TPO Connect in March. Our portal will allow you in Q2 for the non-del cores to disclose your disclosures, including the CD. We think it's a game changer that makes us, in the top 4 for offering that tech. And we do a ton of non-QM, do 50 to 80 million a month. And so, we still believe in old school account executives that really know their shit. So, find one that's local to you, text me, call me, email me. I'm always on. Let's go.
Yep. I mean, one's in the chat, Colleen Palmer right there. If you're in the Mid-Atlantic region, reach out to Colleen. There's no one better, but hell yeah. KP, man. And thanks for your partnership and friendship.
Thank you, brother. Appreciate it.
Later.